Hey y'all, Loan with Jen Hernandez here. So today we are talking about the main differences on an FHA versus a conventional loan. So the video will be a little bit longer. We're gonna just go item by item, like property type, debt to income, credit, so you'll be in the know which loan type might be best for you. So stay tuned. Okay, we're back. So today is a super exciting topic. You're looking at a house or looking to buy a house and you're not sure. You just hear all the noise out there, FHA, conventional. I'm just gonna set the facts out for you right now. Okay, so we're gonna start with property type. So property type on an FHA loan is 1 to 2 units only. It can be a duplex, but you have to occupy one of the units. So it's only for a primary residence. There is no investment property or second home, vacation home in FHA, okay? And FHA, by the way, stands for Federal Housing Administration. It's the loan that's sponsored by the government. Conventional loan, which is a FannieMae, Freddie Mac loan, it's a conventional conforming loan, is 3 property types: primary residence, second home, which means vacation home, or investment property. So all of those apply. Now, we're going to talk about loan maximums. It's all determining on what part of the country you live. So depending where you live when you're buying this, just think on the bookends of the United States, these amounts do not apply. But here in Texas, for FHA, it's $330,350. It's a real funky number. And for conventional, it just changed to $510,400, okay? So that's the loan amount max size, not the sales price. Sales price can be higher than that. So minimum down payment, let's talk about that. So you can get into either type of a loan with a minimum down payment. So FHA is 3.5%. You can be any type of homeowner as far as first time, second time, 10th time. You just can't have more than one FHA loan. There are some exceptions, like if you're moving across the country or because of a divorce or something like that. So check with the lender about exceptions to having 2 FHA loans at the same time. The other type of loan, conventional, you can have as many conventional loans as you want, actually up to 10 is the conventional limit to number of loans that you can have with investment properties and everything. Now, first-time home buyers, conventional loans, 3%, super low down payment, accessible. First-time home buyer means that you have not purchased a home in the last 3 years. You haven't had title to a home in the last 3 years. It doesn't matter if you owned it free and clear or had a loan. It doesn't matter. If you have had title to some type of a property, mobile home, land, whatever, you are not a first-time home buyer. So that's really important to point out. And otherwise you got to default to the 5% down. And this is for primary residence, okay? So 5% down. If you're buying a second home, a vacation home, not a second home down the street, but a true vacation home more than 50 miles away from your primary residence in a vacation type spot like skiing or beach or lake, then a second home is 10% down. And then for investment property, you can do as little as 15% down. So that's super important to know, 15% down for investment property. The next thing I want to talk about quickly also is PMI, private mortgage insurance. We have other videos on what is PMI and how to calculate PMI, so I won't do that here in this video. But private mortgage insurance is required when you put less than 20% down, okay? So on an FHA loan, actually, on an FHA loan, PMI is no matter how much you put down, you have to pay private mortgage insurance. And to find out how long and get more detail on that, make sure to check out our video about calculating PMI on an FHA loan, okay? But it's a very lenient loan. FHA is really super lenient. So where they make their money for the risk premium of being more lenient on their guidelines is because they have a mortgage insurance, okay? So that's required minimum of 11 years. on that, but again, watch that video. Conventional loans, PMI is required until you pay the loan to 20%. Again, I have a video on how to calculate loans, PMI on conventional loans, and also how to waive and get rid of PMI. So make sure that you watch that. So private mortgage insurance, if you put less than 20% down, is part of the payment. Now, on the two, depending on which loan you qualify for, sometimes we will point a client towards FHA for that reason, that PMI might be lower. So it's too lengthy probably for this video, but to just do a really quick segue, credit score requirement and PMI is super connected and important. So again, based on your particular situation, based on your credit score, you might qualify for both loans. And because your credit score is X, Y, or Z, we're going to determine that you might be a better fit for an FHA loan. So just so you know. So that's an important thing to talk to your lender in the qualification. Now, the next thing that's different is credit score. Okay, we're going to talk about credit score. So credit score on FHA can go down to 580. There are some lenders out there I've heard that go to 550. Again, I'm not one of them, but 580 is what most lenders adhere to. So credit scores go up to 850 in the calculation model that lenders use. So it can go anywhere from 580 to 850. The better interest rates are when you have 640 or above. So just something to be aware of. And that's the middle of your two scores. That's how we calculate that, and of the lower borrowers. So we take the lower of the middle of the two borrowers. The other thing that's different, so on conventional loans, the minimum is 660. Actually, if you have PMI, it's 660. If you're doing no PMI, you can actually go down to 620 if you're putting a lot down. Now, the better rates for conventional loans are when you get into the 700s. So it goes in increments of 20, like 680, 700, 720, all the way up to 760 is the very best tier to be in, 760 plus. So that's something, again, to review with the lender, and just be cautious when you're looking online, because you might see a rate, but you got to make sure that it applies to the credit score that you have. So that's something to watch. Our Truth About Credit videos. So another sideline to really make sure that is important that you know is a big difference between FHA and conventional on credit is how they look at bankruptcy, foreclosure, and short sale. So FHA is super lenient. Remember, I was talking before that FHA is really lenient. That's why they require PMI no matter what. So you can have a bankruptcy as little as 2 years ago. You can also possibly have just finished bankruptcy. There are exceptions. Check with the lender. There are extenuating circumstances that would have to be proven. Usually it has to do with health or loss of job are the most common reasons, things that were beyond your control. Divorce is never one of them, unfortunately, but do check with your lender. So on a short sale or a foreclosure, FHA is 3 years, so that's really lenient. Now we're going to pop over to conventional. Conventional is 5 years on bankruptcy and 7 years on foreclosure. There's no exceptions, and also a short sale is 3 years. But again, there's really no exceptions on that. FHA is where there's a lot of exceptions on those type of credit events, okay? So that's how you have it on. All right, the next change, or that something is different, is debt calculation, how debt is calculated. It's called a DTI, or a debt to income ratio. On a FHA loan, 55% is the max in most cases. I have to put an asterisk by most, because there are some cases when your credit score is below 620 that only 50% is allowable, okay? So then jumping over to conventional loan, the max debt to income ratio is 50%. And again, this is of your gross income. So we determine the income first, and then we weigh it against the monthly debts. Now there's another asterisk here on debt to income ratio for conventional of 50%. And that is that it's all of these programs, FHA Conventional, are subject to automated underwriting. So you might have a 50% debt to income ratio and you're within the guidelines. However, the automated underwriting has determined that you have a high risk factor. Usually that's on low down payment loans. So 3 and 5% down, the debt to income ratio is tighter, and sometimes, not all the time, the debt to income ratio that it likes to see is 43, 45%. So again, it's super important that you get with a lender super early so you can determine which bucket you're in and what your maximum can actually be. But this is just generally speaking, Fannie Mae will allow, subject to automated underwriting, up to a 50%, okay? So the next thing on debt calculation, so we talked about debt to income ratio. It's really important under the debt scenario when we're identifying your debts that everything is disclosed, no matter what type of loan it is. So any properties owned, no matter whether you have a loan on them or not, you've got property tax and possibly insurance and HOA fees that you're responsible for. So it is super important that you disclose to the lender any property that you have an interest in, even if it's shared with a relative or you inherited it. So make sure you talk about that because we're going to find out anyway. So you might as well disclose it. The other thing to talk about importantly, and this is on both loans, student loans are viewed differently. So on FHA is actually super strict on student loans. So let's say you have $50,000 in loans with you graduated or whatever, you've got $50,000 worth of loans. FHA mandates that we take 1% of the balance. So that would be $500 on $50,000 worth of loans. Does not matter that you're in deferment, does not matter that you're on an income-based payment. So that's actually a detriment to FHA, is that they're really strict on how we calculate student loans, okay? Conventional is actually really lenient. They will accept income-based payments as long as we have a letter from the creditor that the payment is, gosh, I had one recently, it was zero. The income-based payment was $0, $9 on some of them. We were able to use that on a conventional loan and we did not have to default to 1%. However, we have to default to 1% on student loans when there is no payment identified. So if you can't get a letter from the creditor about what the payment is or going to be, we have to default to the 1%. So work closely with your lender on that. Student loans are super important. Other debt, if you have a relative or someone that you've co-signed for, we can show that they pay it for 12 consecutive months. Let's say a car is something common. We see relatives signed for cars, for friends and whatever. 12 months. We have to see that it's been covered for 12 months with canceled checks or proof of payment from their account to the creditor directly before we can take that off of the debt side. So that's on both kinds of loans, okay? Now, let's talk about income calculation. Super important. The income has to be likely to continue for at least 3 years, actually. It has to have been received for 2 years. Now on income, it doesn't have to be from the same job. So that's on both kinds of loans, FHA or conventional. FHA, again, is more strict on work history. So FHA has a guideline actually that if you've changed jobs more than 3 times in a 12-month period, you are risky and that it requires further review. Okay, so 2-year history total income is really super important. Overtime, bonus, commission, self-employed, 2 years, hands down on FHA. Conventional, go over to conventional, and conventional, actually there's some shortcuts. So depending on the scenario, depending on the situation, it is possible that we can take 18 months of overtime and multiply it or divide it over 24 months. Also, if you've been self-employed more than 5 years, we possibly can use 1 year of tax returns. So that's a good little nugget to know. Now going to another, and we're almost done, the video's almost done, so hang in there with me, please. I'm almost done. And really important, seller credits. A lot of people want to use seller credits or realtor credits or some type of credit in order to help them with closing costs. And so FHA is really lenient. 6% credit, 6% of the purchase price can go towards closing costs. Conventional, if you're putting 3 or 5% down, it is 3%. Okay, so it's a little more strict. However, if you put 10% down or more, then it's 6%. And if you put more than 20% down, it is 9%. When are closing costs ever that high? Well, you could buy down the rate, you could be doing a 2-1 buy down, or you could be doing upfront paid PMI. So just some examples for you of some things that we've seen. So check with your lender about that. But really important note, this is super, super important. You don't want to miss this. The seller credit, seller, realtor, whatever credit cannot exceed the actual. You cannot have those credits dip into your down payment. So that's really, really important to know, and that's on both kinds of loans. Now, the very last thing that I'll come up upon that I think is really big to know, and then we're finished, is residency. So with both kinds of loans, you can be a citizen, a permanent resident alien, or you can be on an approved type of visa and or work permit. When I say approved type, I'm not going to name them all here. There's about 30 of them, and there's many that are not. So it's and they're constantly changing. So it's important that you check with a lender on if your visa type or work permit is approvable. I can tell you that there are no TIN number, tax identification number loans with FHA or conventional. Those are private types of loans that you'll have to look somewhere else that are available. We don't do them. And then also DACA, the Deferred Action Childhood, oh my gosh, whatever it stands for, that is conventional only. So FHA does not allow the DACA visas, but they will be allowed in conventional. So those are the most important highlights that I've deemed in this video. There are more, but it just depends on every situation. I thought these were the most pertinent if you're deciding if a conventional or FHA loan is pertinent to you. Take care, and we'll talk to you soon. Legacy Mutual Mortgage is an equal housing opportunity lender. The opinions expressed here do not reflect those of Legacy Mutual Mortgage.